Good morning, everyone. Thank you for tuning in today. I am Tanya Subatang, Programming and Membership Director. I am pleased to welcome you to our webinar, Addressing the Low Return Challenge. Before we begin, a quick item to note. We will be muted for the event, so we encourage you to type your questions into the Q&A box. We will monitor the questions closely and endeavor to have as many questions answered as possible. This event will also be recorded, and we will share the replay. Now, at this time, I'd like to turn it to Ken Frier, CFA. Ken is the Chief Investment Officer at Atlas Capital Advisors and a member of the CFA Society San Francisco Member Programming Advisory Council.
Hi, everyone, and thanks for joining us today. It's a great privilege to have with us today Dr. Antti Ilmanen, the Global Co-Head of the Portfolio Solutions Group at AQR Capital Management. He is one of the smartest, most knowledgeable, and nicest people I've ever met in the institutional investment world. And his books are required reading at the world's largest and most sophisticated investment organizations. He's received multiple awards for his work. Dr. Ilmanen earned MS degrees in economics and law from the University of Helsinki. You can hear the Finnish accent a bit. And a PhD in finance from the University of Chicago. We're here today to talk about the insights from his most recent book, Investing Amid Low Expected Returns, What to Do, Making the Most When Markets Offer the Least, and his work since then. So we'll start by exploring the low return challenge, and then we'll move to what Dr. Ilmanen thinks we could do about that. So Antti, the book Investing Amid Low Expected Returns, it has three parts. The low expected return challenge, the menu of building blocks for investment portfolios with their expected returns, and then how best to put those building blocks together to form optimal portfolios. So let's discuss each part in turn and what's changed in the markets and your own thinking since you finished the book a couple of years ago.
Very good. And thank you. Thanks for inviting. Thank you for the very kind words. And just a warning that we agreed with Ken in advance that I can have a few slides. It's not going to be a presentation, but I'll have a handful of slides that I'll put to the background then when we talk.
So let's go back to the book and the first part, which sets up the problem, the low expected return challenge. Can you remind us of that story? You know, what happened in the 10 or 15 years leading up to when you published the book, and then what's happened since then?
Yeah. So let's just see. First, I ask, you are seeing this fine? I think the middle thing should disappear. Yeah, good. I hope the screen looks fine. So as a background, and so we will come back what happened since the book came out 2 years ago, because a lot has happened. The big story is, when you think of expected returns, not realized return, the big story is that in the last 40 years, we saw expected returns on all major assets decline a lot. And in this picture, I give you a very long run perspective dating back to 1900 on in the top panel for S&P 500 and beside it, 10-year treasury yield, expected real returns using some really simple yield-based estimates, looking at dividend yields, earnings yields, or 10-year yield minus some inflation expectations. And lower panel here shows the 60-40 portfolio expected real returns. And there you can see basically pretty much 4 or 5% returns coming promised in the markets and pretty much realized through much of the 1900s. No trend, just cyclical variation. But last 40 years, we saw this big downtrend. 40 years ago, we were in a world where all starting yields were high, asset valuations were low. Then we got 4 decades of richening assets, declining required real yields on all kinds of investments. And that really culminated in 2021, when both stocks and bonds were near all-time most expensive. And you can look at other asset classes. You can look at real estate or private assets and so on. Pretty much any asset had its valuations near the highest level ever. And I think there is this danger in such a situation that sort of motivated me to write the book, that people look at the rear view mirror, especially equity, or like basically bond investors tend to look at starting yields. Equity investor and illiquid investors look at the rear view mirror of past average returns. And then they get sort of sucked into excessive expectations. whereas again, forward-looking pictures are told that this is sort of dangerous now, and one should recognize that through those richening valuations, we were effectively borrowing returns from the future by getting all the good news to the high valuations. Okay, so that's the story, I think, when the book came out 2 years ago, and a lot has happened since then.
Well, as you can see on the top chart, the key thing that's happened since then is if you look at the light blue line, the big rise in expected returns on fixed income. So Antti, will you discuss that further and what the impact, if any, has been on asset classes outside of fixed income?
Yeah. So I think when I'm trying to think why did all assets richen in those preceding decades, I think there was a common story there. It was related to this idea that all assets can be priced by thinking of expected future cash flows discounted by the common riskless real rate and some asset-specific premia. And it was that common real rate being so low, negative real yields, sometimes outside US even negative nominal yields, that was making all assets expensive at the same time. Then it wasn't the word of compressed premium. It was everything expensive for this common discount rate reason. And then something happened since 2022, and other asset classes seem not to care in particular. So this is a little different than looking at TIPS yields, but it's a very similar story. So TIPS are inflation-linked bonds. If you think of 10-year TIPS yield, that was for several years something like -1%, so negative real yield. And then it rose from -1 to 0 to +1. Nowadays, it's close to +2. And many so-called real asset owners said that nothing to do with us. And it's just not realistic. So basically, we got this, what I call the fast pain of repricing in the bond markets, so both in cash side and in Gavi side, and even in many credits. But we didn't get much of that in equities, and we certainly didn't get much of that in private assets. So I think it's really hard to interpret what's happened in the last couple of years as a rational reaction. I think it's been a case of wishful thinking, remaining hopes that somehow this, initially we were not supposed to have so high rates, then the rates were not supposed to stay high for long, and so on, and that has allowed the good bid to stay in risky assets and private investments. I do think that that now forward-looking picture is very, very different. So actually, like if you look at just the top picture, a couple of years ago, you can see a pretty big gap there between the bond and equity part. So I think a few years ago, we were in a situation where we had pretty normal risk premia. And now we have moved to this situation where we have very compressed risk premia. I don't have it here, but when we look at our capital market assumptions, expected returns for various assets for next few years, they basically shown this increase in all kinds of fixed income and very little change in valuations and expected returns on equities and illiquids and so on. So now a world of compressed risk premia. And if I can, I'd like to show something which is quite cute that my colleagues did. That's on the next page. Let's see. Yeah, good. So I was just telling that we see very different expected returns and compressed risk premia when we look at current forward-looking indicators. But my colleagues did this nice study last year where they, and this actually just came out in New Journal of Portfolio Management, something like Honey, the Fed Shrunk the Equity Premium by my right-hand guy, Thomas Maloney. Anyway, so the exercise is asking, what's been the historical pattern when you look at low rate environment and high rate environment, and what kind of realized returns do we get for various assets in that environment? And the study looked at last 100 years, or like in this picture, last 50 years, or last 30 years, sort of ever broadening the asset class universe when you have got shorter history. And in this case, so you can see in the top, you can see history of US cash rates, so basically short-term rates. And this could be as simple analysis as just looking at historical average or median cash rate and saying high versus low, studying high versus low based on that, you would get very similar results, as I'm going to emphasize now in a moment. But actually, it's a little too naive to do that, because people in 1970s, 80s didn't know what's going to happen in the future, whether those rates would be prospectively high or low. And maybe as importantly, today's investors don't care about 70s, 80s. They look at back to 2010s. Our memories tend to be 5-10 years long. And today's rates are high because they are high compared to the 2010s memories. Anyway, so we were just taking a couple of different ways of looking at analyzing this, and all of them gave something like what you see in that lower left panel. It showed that when we compare average realized returns in high versus low rate environments, treasuries held up pretty well with cash. So if we had constant premia across for any asset in high and low rate environments, then you would see parallel lines compared to cash. Treasuries are pretty parallel, but when you look at equities or real estate or high yield, they are not even flat, they are downward sloping. So that tells that the typical, that what our forward-looking indicators tell of this compressed premium, that has also been typical in past realized returns. When we are in higher rate world, like what we see in 2020s, we tend to have much more modest excess returns on equities versus fixed income. And otherwise, I would say also with privates versus fixed income. We've done this exercise since 1990s with private equity. It looks sort of like equities a little higher and a steeper downward slope. So it's like levered equity. So to me, this is telling something quite important, that 2010s was great environment for equity market risk taking and illiquids. 2020s looks much better for fixed income. And then on the right-hand side, it says that same is true for long-short strategies. Long-short strategies seem to act like cash plus, and they should. Basically, you have got your cash investment, you overlay some long-short strategies on top of that, and this is what we have seen historically. So from today's perspective, we think that it's a much more competitive environment for diversifiers that disappointed in 2010, such as these long-short strategies or some bond investments compared to equities.
So hard to eke out much of a return over cash, even by taking a lot more risk. I mean, you're broadly familiar with the world's allocators around the world, and most of the ones I know are shooting for a return of inflation plus 5%. But based upon current conditions, what would be your number? Like, what do you think is a realistic expectation for your typical institutional allocator?
Well, it is more realistic when the base case, the base riskless part has increased from -1 to +1, +2. So I think getting somewhere to that 5 is more plausible now. Our 60, actually, like if we go to that previous page, you can see that we would say 60-40. This is saying 2.5% now. It was basically trapping at something like 1.2% in 2021. But let's be a little generous, adding credit spreads and so on here, and saying that non-US markets are a little cheaper. So we could say 3% real for 60-40. So somewhere you've got to squeeze that extra 2% from somewhere else. And I think we'll later come to some of these other ideas. The most common answer, of course, is illiquids, and I'm going to argue that that's an overrated. Yeah.
Why don't we turn to that, because you have a very interesting section in your book about how you see allocators responding to this low return challenge. Yeah. And you think about two categories of response. One response is to increase investments in private assets, private equity, private real estate, private credit. Another response, which you discuss at length in your book, is investing in long-short liquid style premia. And I think the audience would be very interested in your thoughts, both about illiquid assets and about these long-short strategies.
Yeah, and maybe we can come. Yeah, I think there's a lot to cover there. So really, the second part of the book covers all kinds of long-run return sources: asset class premia, illiquidity premia and long short strategies. And maybe I'll just step back to your point and say that when investors, now I'm talking of large institutions, when they sort of really felt this pressure in 2010s that, okay, forward-looking indicators suggest it's a world of low expected returns, almost nobody said that, okay, markets are offering less, therefore we should accept less. Almost everybody said, hey, we want to keep earning what we are used to earning, spending what we are used to spending, therefore let's reach for return, let's reach for yield. And it was just a matter of how they do it. And there were three common approaches. So one was just, let's raise the equity allocations, or let's raise the private illiquid allocations, or let's try some long short strategies or alternative risk premia, or maybe factor strategies, long only fact. So and all of those were on the table in 2010s, and all were considered and applied, I think, by many institutions. More recently, it's been very much just the second one, the illiquids, private illiquids, which has been there. And so now with that backdrop, I'll take this. This is summary picture of my book second part, of talking about timeless or very long-term sources of expected return. So I'm arguing, and there's a lot of, there have been many other studies by myself, my colleagues, many other people in academic and practitioner world. And I'd say that literature can sort of coalesce or can be summarized roughly in this table with lots of information, lots of detail elsewhere. But so if we ask which return sources have most compelling long-run empirical support, it's going to be a few asset class premia and a few long-short style premia, and it doesn't include illiquidity premia. So I will come to that, but just hear me out first on this one summary slide. So this is almost 100 years of data. The bars are average returns, or actually excess returns over cash, compound average return over cash. And those lines, circles with the lines, they are Sharpe ratios, which you can read from the right-hand scale. And so the items here are, the blue are asset class premia, first equity premium, then duration or term maturity premium, basically extending maturities in bonds. Then there's credit premium in bonds. And then there's commodity premium. Commodities, as a diversified portfolio, have had surprisingly nice long-run return. That's not often understood. And then the green things are these various long-short style premia, or sometimes called alternative risk premia. And they are things like value, momentum, carry, and defensive styles. So, and these are styles that have worked pretty much in every asset class we have studied. So not just in stock selection, but also in country allocation, in equities, bonds, currencies. So value, buy cheap, sell expensive, using various signals. We may drill a bit more on that if you want. Momentum, roughly buy last year's winners, sell losers. Carry, buy high yielders, sell low yielders. Defensive, buy the boring stuff, sell the speculative stuff, such as favor quality stocks or low volatility stocks compared to more speculative stocks. All of these strategies have worked in the long run in many of these places that we study, but they have also disappointed everywhere. And the last thing is trend following, which is similar to momentum in the sense that it's a strategy that favors last year's winners versus losers, but it embraces directionality. All these other strategies try to be market neutral all the time. Trend followers say that if all risky assets went up last year, I go risk on in every asset, and I will embrace that beta. And in bear market, I'll go short all of those things and embrace the bearish positioning, which makes it a very good risk mitigator. Hopefully something will return to. Anyway, so my main point is all of these strategies have helped in the long run. Of course, another, maybe before I get to illiquids, I already want to say what you can see there above that chart is I was preaching in 2010s also to you this idea of diversifying into many return sources. Here's a good menu of things that you should invest in. Don't let equity risk dominate your portfolio. In reality, most investors let that first bar dominate their portfolio. Equity risk dominates almost everybody's portfolio. And And maybe I've sort of changed my tune on that a little. Maybe it's just as well because people can be more patient with equities. That's the only strategy out of this where people can forgive a bad decade. Like US equities even have had 3 negative real returns decades in the last century, 1930s, 70s, and 2000s. We'll still see about this one, what's going to happen. But so 3 out of 10 negative. It happens for almost any investment. Only equities will retain their investor base when such a bad decade happens. With anything else, it tends to be 3 bad years and you are out. So that patience is a really hard thing to stick with. Anyway, so this was all now background, and then there is this, you can see almost an empty space between the blue and the green, which could be the illiquidity premium, which isn't there. One reason why illiquidity premium isn't there is that we don't really have 100 years of data on illiquids. So I guess the longest history we have on that's sort of relevant is we could look at US real estate. We could look at REITs, which are listed and relatively liquid compared to direct real estate, which is not. We've got 50 years of data, and that 50 years has got actually a negative premium. Those listed REITs have had much higher return, and there have been some arguments why that's fair because they don't they've got leverage and they've got mark to market volatility and more equity beta and so on. It's fair, but any adjustments that people have tried to do sort of can maybe explain away the negative illiquidity premium, but not flip it to positive. So again, the long run story is not so great. And if you want, so this is now optional. I mean, the most important debates have been about private equity. And I can tell you like a story there why I'm cautious there, even though I would say that, with the 30, 40 years of data we have, they have had very good history. But I think the summary for me is that private equity, great history, not so great last 15 years, and very dubious, or like, let's say, prospective picture looks much worse now. If you want, I'll give a quick story on that. But
on this chart, you're showing returns over the last 100 years. But if we focus on probably the most important bar for our listeners, which is stocks over cash, the historical number 6%, but that's a lot higher than what was suggested even by the prior slide, where you look at stocks over cash in high cash rate regimes. With cash at 5%, are we going to get 11%, on stocks going forward? Like what would be your number?
Yeah, so it would be much low. Sorry. So last decade was a very strong decade for especially US equities. Global equities, it wasn't so exceptional. For US equities, it was after they had a very disappointing decade from 2000 to 2009. But basically from 2010s, early 2010s onwards, there was even a decade when many forward-looking estimates were saying that you should get 3-4% expected return on US equities. And by the end of 21, and now I'm picking a point when they were at their most expensive, they actually had delivered 14% real. And at that point, we made a sort of painful post-mortem and asked, hey, what the hell did we get wrong? And that's what you are asking. And we have basically the accounting answer is that most of that strong return that US equities gave in that decade, and even now if you look at decade back, it wouldn't be as extreme, but they still had probably a double-digit return for the last decade. So what happened was that the valuations changed a lot. That's the most important thing. So for example, so-called Shiller-Cape ratio, that went from 20 peaking at the end of 21 near 40. So it pretty much doubled. So doubling valuations. And that was pretty much the time when yields were low. Now it's a bit different story when yields have increased. So it's not quite doubled valuations, but it's still probably valuations have increased 50%. And when you prorate the impact of that to annual returns, it's meaningful. For that decade ending 2021, it was basically 14% real return, and 7%, half of that came from this repricing, doubling of valuations. I sort of tried to say it cutely at that time, to say that markets went from mildly above average valuations, where they were already in early 2020s from historical perspective, to wildly above average valuations. And so the valuation increase was the most important thing. Secondary consideration was that growth, earnings per share growth, was faster than expected, but that was only worth a couple of percentage points, not the 7% that came from that valuation increase. So the point is then that even for time periods as long as a decade, this kind of really long-run history is going to be overwhelmed by things like valuation changes. And we just got this decade which had very strong US valuation increases. And by the way, like again, the preceding decade had the opposite pattern. There was negative US return for that preceding decade there, because valuations were falling. So I guess if I'd summarize, I'd say that it's hard to forecast even next 10 years. Next year's returns are hard to forecast. Next 10 years returns are also hard to forecast. If there's what history says is that you get some clues from looking at these starting years, and you get really bad clues by looking at last 10 years average returns and extrapolating from those. And yet that extrapolating from those last 10 years returns is sort of psychologically the most normal and common thing for investors to do.
We got an audience question that seems relevant now. The question is, in the story of the declining expected returns in the last 40 years, is it partly explained by having relatively more capital put into the stock market from aging populations, kind of a surge of investment from boomers, that led to equities being bid up? And how do you think about this going forward?
That's good. Yeah, I think overall, I told you, if I have to say the first proximate answer is this idea that basically all assets benefited from these declining real yields on treasuries and so on. That's including equity. So all assets benefited. The demographic story of the aging and pension demand, it doesn't tell too much of stocks versus bonds or real estate. When you try to pinpoint which asset class benefited most, data just doesn't tell almost anything. They all assets benefited in those recent decades from that aging and the growing pension demand. And indeed, so I would say that when I think of what's the key story for this idea that recent decades have had this very strong performance for various assets, it is the kind of savings glut stories that come from this, or of which this demographics, aging and growing pension saver demand is a key part. And actually, so again, the idea is we are saving more, we are bidding up the asset prices. In some sense, we are digging grave is a bad word now here, but we are making our challenge greater by pushing those valuations higher, asset yields lower. This is what we were doing collectively with the pension saving. So I think that's a very important part of the story. But interestingly, some academics came up with another savings glut story, which they argue is even more important. I mentioned it somewhere in the book on chapter 2, if I remember right. And it's the so-called savings glut of the rich. And it's this idea that basically we've seen this big transfer of wealth in favor of the well-to-do, of in extreme, the 1%. And during the last 4 decades or so, this is something you could see in any data look at wealth distributions, and that 1% has got much higher savings rate. Basically, other lower deciles than first 2 deciles actually often have a negative savings rate. So basically, much wealth went to the higher savers, to the very rich, and that means a big savings glut is just a result of this. So anyway, I do think that these 2 forces, demographics and this savings glut of the rich, they are very important reasons why all assets were getting richer. And they are also reasons why I think that we may stay, if you look at this first picture, why we may stay at below average expected return. So in the lower panel, I show that we are at 2.5% real for 60/40. That's still clearly, it's higher than the trough at 1.2, but the long run average has been more than 4%. And I suspect we don't go to that 4% or something, which is sort of good news for investors, because that would imply lots of cheapening, lots of pain for capital valuations. But so I don't think we'll go there unless those two forces go away. So somehow that we would get this basically wealth transfer going the other directions and the demographic story changing. May happen, but I'm not going to predict when they will happen. It's surprisingly difficult, actually. Even demographics are sort of like, it's been hard to figure out what the already retired US pensioners are doing with their investments. You know, they certainly didn't all move from equities to bonds. If anything, they have stuck with their equity investments. And so again, demographics turned out to be harder things when you are thinking of stocks versus bonds. But the idea that the bid from baby boomers pushed all assets valuations higher is a very reasonable one. Sorry, long answer, but very important topic.
If we look at this chart and read the book, one of the key takeaways is that the Sharpe ratios of these long shorts strategies are quite respectable, perhaps even better than the Sharpe ratios of the mainstream asset classes. You know, we can see that the light blue line with the circles is higher on the right than on the left. But as you've already noted, Antti, it sometimes can be difficult for people to stay the course. For instance, with value style, where long short strategy, you buy stocks with low PE ratios, sell stocks. I'm oversimplifying, sell stocks really, you know, with no earnings or high PE ratios, and on average that works out. Can you talk about the challenges to investors of embracing these style premia in their portfolios?
Yeah, I will, and I'll just first I say one thing. I do tell it clearly in the book, and you would see it in the small print that I have not adjusted those strategies. I haven't adjusted any of these strategies for trading costs and so on, but they tend to be higher for these long short strategies than for asset class premia. So therefore, if we could make that adjustment, that this would be lower. But I try to balance it by making the versions of strategies I show here very naive and simple. So it is really, in this case, just book to price and no, I don't know. Well, we'll talk about that in a moment. No industry adjustment. So with value and so I'm trying to make them so simple to compensate for the fact that I'm not adjusting for trading costs. And the reason why I'm not adjusting for trading costs is that while we know pretty well what the trading costs were for the last 30 years when we were in business, we really have no clue what they were in 1960s, 1940s, whatever. And I just don't want to get to those debates. Anyway, so now, again, your key point, I think, is very valid. These things look at least as attractive as market risk premia, but people can't stick with them.
And moreover, they tend to not be correlated with the equity market, and so
that's an extra thing.
Positive Sharpe ratio item that it also isn't correlated to equities.
And they are only correlated with each other. You can combine them and you can boost the Sharpe ratio, and then you get something which historically has been wonderfully diversifying and improving versus equities. But that's a long run story. Each of these styles can disappoint sometime. And let's go for that case that you were saying. This is the value strategy here now. So this is, again, buying cheap stocks compared to expensive stocks, and you can do it looking at many metrics: book to price, earnings to price, sales to price, etc. Actually, we are averaging many of them. One thing that we do importantly in our way of doing value, there are always many ways of doing each of these strategies. We say that you shouldn't compare all the stocks, let's say in US universe. You don't want to compare a tech stock to a bank to an energy stock. You want to do most of these comparisons within industry. And if you do that, you get better comparability, better diversification, and better results. So, for example, here, when you look at the top panel, you see cumulative returns since 1990, which were basically making money up to 2017, then 3 horrible years, and then now a pretty nice recovery. If you were doing this more naive version, which you sometimes see in Wall Street Journal of some S&P value versus growth or pharma French factor, they do what I just said. They look at the whole universe and they don't look at within industry. And that strategy has started to already, basically, it hasn't still gotten back to the 2007 high. So it's got a very long drawdown. But this strategy has worked the last 30 years. And actually, like I would have 100 years or some version, I would have 200 years of it. The long run story is good, but the 3-year story, which you can see there, 2018, 2020, mid panel shows drawdown from the peak. It shows that we got this horrible window which was basically the steepest and longest drawdown pretty much for any version of value strategy. And I think we can think why that happened, but it certainly turned out to be unbearable for most investors. Investors gradually threw in the towel. Not everybody. We are very happy. We have got some investors who are still with us and who have been enjoying the recovery since 2020. But roughly speaking, you can think that there was growth. Basically, this is value versus growth. And it became obviously linked to this idea of the shift from physical world to digital world. And that idea worked very nicely, and it had good fundamental underpinnings. But at some point, markets basically took the pricing of value stocks versus growth stocks away from the fundamental underpinnings. You started to basically, there was no more fundamental advantage to those growth stocks, but they were just repriced higher and higher. And this kept happening in late 2010s. Larry Summers has said it nicely that value strategy works when investors over-extrapolate past growth, but the real danger is when that past growth, when that strategy succeeds for many years, and those over-extrapolating investors become overconfident, and then we get a bubble. And I think that was happening around 2019, and it sort of made sense to be cautious about growth stocks. But then we got COVID, and COVID lockdowns were very good for many growth stocks. So that's the sort of the last killer in 2020 for value strategy. And since we have had basically the news of vaccines in November 2020, value strategy has been recovering pretty nicely there, at least our version of that. And you can see it in the recovery, and you can see in the last panel we look at the forward-looking picture how attractive value stocks are versus growth stocks. And they were very, very attractive a couple of years ago. They are still pretty attractive, but not quite as much. But basically, the only 2 times in history looking at this or even longer histories would be basically the dot-com bubble and the situation a few years ago, where we saw such a great opportunity in value versus growth. But in both cases, the opportunity came through much pain for any value investor. So, and the broader point, of course, was this: it's really difficult to stick with these types of strategies. If you need everything to work for 2-3 years, it's very difficult to make these things make them have big allocations. We do think diversification helps, but even that can sometimes be overwhelmed when something has as big effect as this one did. So I still love these things, but I'm more cautious, more humble when I'm recommending them to investors. I'm saying, if you can't handle a few years of disappointing performance, if you are not as convinced on these strategies, then you may want to make very modest allocations, and certainly very diversified allocations, so that you don't get anything like what you see in this picture.
Yeah, the interesting behavioral challenge is what you described, that if we have 3 years where a value long-short strategy has a bad drawdown, then, as you said, most people throw in the towel, and therefore the gains that could have been enjoyed in the last couple of years are just not being experienced by those who gave up on it. You could think about what the world would be like if we all gave up on equities anytime there was a bear market, and say, I'm never doing equities again, and how that would work out. I mean, yeah. What do you think needs to happen for like institutional investment organizations to be able to stay the course? Or do you think that they'll ever kind of be able to get past this kind of 3-year trial period? And if it doesn't work, then I'm not doing it.
Yeah, it's definitely hard. And by the way, the silver lining here is that, like Cliff sometimes, our boss Cliff Asness says that it's that's the reason why these premia persist in the long run, that they are sustained because investors can't stick with these strategies. And I think there is something to that. But in the book has got lots of ideas of how investors could try to cultivate patience in the organization. But ultimately, I'm just I'm trying to help. I don't think there is no way of totally solving that. I think there are ideas such as learning more about risk strategies. I am so confident in this because I have studied these long run histories. I know that these strategies have worked 100 years in many different asset class contexts, and therefore 3 bad years do not make me lose faith like they do for most investors. And I've got very good ideas why they work. And then when bad things were happening, we were doing all kinds of postmortems on the fly, checking all kinds of stories why value would be dead now. And of course, the articles that value is dead, they were peaking, of course, just in 2020 and so on. So sadly, I don't have an easy answer, but I do think that for those investors who can be more patient, there are some interesting remaining opportunities, not just in this strategy, but overall with all of these strategies.
By the way, as a reminder to the audience, we are taking questions, and there's a Q&A button at the bottom of the screen. So if you have questions for Dr. Ilmanen, then please send some through. We do have a question recently. It is, do you think that there's a bubble in emerging market growth stocks? Well,
I think there is a bubble in growth stocks. I guess I do think that, again, it wasn't, that's sort of a story here. And it is true that we see, when we look at this kind of value spread, what you see in the lowest panel, it is the most extreme in emerging markets. So I have got some sympathy in that. The only counter story is that overall emerging markets are cheap especially compared to the US markets. So I suspect that the bigger bubbles might be in the local side than in emerging market side. But as a relative thing, yes, emerging market value versus growth, that is right now quite extreme. And if I'd want to do this strategy in one place, one region, it would, now taking region very broadly, loosely, it would be emerging markets.
All right, let's turn to the third part of your book. The part 2, you're talking about what's on the menu, what might we expect to earn from what's on the menu. And then part 3 is about construction, right? How to put together the portfolio and manage portfolio construction, risk management, cost control, ESG, tactical timing, etc. One of the topics that interests me in that section is downside risk mitigation. And what are your thoughts about that? Do you think that should be a general part of investment strategies? And if so, what should people do?
Yeah, I in some way, again, I have changed my preaching point. I just go back to that previous slide where I told that I was preaching last decade, diversifying across this. But now I'm sort of saying, okay, maybe it makes sense that you investors let your portfolio be dominated by that equity risk. But then you should ask the question, what happens when that equity risk materializes, when you get some really bad news for your portfolio? And that has guided me to study a lot the topic of risk mitigating strategies. And my last slide would be on this topic, and we can take it further, but I'll just explain what this is then. So if equity risk dominates your portfolio, you should know what strategies were helping when equities really suffered. And for that purpose, I created this table, which has got basically the biggest drawdowns for S&P 500 over the last century. You got the dates, how many months long the peak to trough drawdowns were, and how deep the drawdowns were. And then you have performance of 5 most popular risk mitigating strategies. Put is buying out of the money index puts on S&P 500. Trend following is basically doing trend following many different liquid assets, looking at 1, 3, 12-month trends, something very sort of classic core trend following type of strategy. 10-year treasury, gold. The last one is long short strategy on quality stocks. It's quality minus junk US stock selection. Each of those things has been helpful in many of these and in most of these bad times, but each of them sometimes disappoints. The treasuries is the most famous one, the middle one there, and you can see when you look at the lowest row, you'll be reminded that it wasn't too helpful in 2022. So 22, okay, and the same happens to be true for gold. And if I can, I'd say something about put versus trend, because those are two things that have been debated a lot among the experts or market participants, including myself. I've had some debates on Taleb over the years on this. And my main debate with him has been about long-run average return, where I point to historical data and I say, what you see on the right-hand side now in the picture, I call that the scissors chart. One line going up, one going down. The line going up is the long-run return on trend following, and the red line going down is the long-run return on put buying strategy. So trend, puts are so expensive that I think it's so difficult for people to stick with it. It turns out that even with the blue line, with the trend following, with positive long-run returns, you can, if you look at it carefully, you can see basically a flat decade in 2010s and a drawdown there after 2015 for a few years. And already that challenged investor patience too much. Back to that patience topic, and many investors basically gave up on that, let alone on the red line. So I think that's an interesting contrast. Another interesting contrast is that put strategy is much better for fast crashes, and you would see that in the second row from the bottom, the COVID crash. Put strategies were doing very well in 2020. Trend strategies not so well. Trend does much better in a gradual, protracted bear market, such as 22, when put strategies can disappoint. So we've had sort of perfect environment and not so nice environment for each of them in the last ugly time that we saw. So I think there's a case for both, but one big difference is, of course, this long run return.
But of these 5 choices on your downside menu, which do you think has the best combination of protection in bear markets and lower cost of insurance in normal markets?
Yeah, I think so. Clearly, I think the best 2 in general in performing are maybe put and well, you can debate that, but cost-wise, put is clearly the worst. Trend is historically the best. Treasuries and quality, basically defensive stocks, quality versus junk, they are sort of second best, and gold is sort of it's not as bad as puts. It's not losing money like that, but it is in the long run, it's pretty much earning 0 real return. That's sort of the long run story of what we've gotten from gold. So the rankings, if I have to pick 3 of these, the first one would be trend, and its cousin macro traders, and then treasuries and defensive quality stocks would be the other 2, the other medalists maybe in that comparison. Maybe one observation, just I mentioned this fast versus slow, and we have found that because investors have put so much more money into private assets in the past decade, it's interesting to note that trend following is what we call a match made in heaven with that, because for private assets, they don't have to worry about the fast crashes like the COVID event. The smoothing takes care of that. It's only a protracted bear market which is a problem for private assets, and trend following is therefore a great complement for them. And I would have in appendix a nice slide on that, which shows that in virtually all bad times for private equity, trend following strategies have done beautifully well. So this is something that investors didn't care much about 5-10 years ago when they didn't have yet as much privates. Now that private allocations have increased, the story that, okay, this could be even more relevant for us than what this table implies, really resonates with many institutions.
Well, we're almost out of time, and I don't have questions from the audience. I do want to ask you one last question, though. And I'm personally curious about this. I mean, there are many people like you who have traveled the world meeting with all of the world's largest allocators, and you're there with a mindset of an allocator yourself. And I'd be interested in your just general thoughts about the state of institutional investment management around the world. You know, what you're seeing, what you like, what you think would be, you know, one or two of the most important things that you'd like to see institutional allocators do that they might not be doing to the scale that you think would be helpful.
Yeah. No, I think overall, well, a couple of things. So they do like the stories in my book. You can go and look at the blurbs, and you see lots of nice comments there. And so that's great. But I think they can't always, I don't know, they can't always maybe help themselves. So I think many institutions, like maybe also many individuals, but certainly institutions, when they look in the mirror, they say aspirationally, they see a patient contrarian investor. But in reality, they do often chase last 3 to 5 years performers, and they capitulate after 3 to 5 bad years. And so it gets to that patience question, and they know that they should do better, but it is just very difficult. And there is again, Cliff has got this nice saying that investors act like momentum investors at reversal horizons. So at 3 to 5 year horizons, financial assets often have got mean reversion tendency. So it's a really bad idea to do this type of those types of multi-year pro-cyclic flows. But again, institutions often do that. They know they should do better, and I think that's partly they have appreciated the patience part of the book while knowing that it's really difficult to change behavior. So that's, I think, one thing. And the other thing is about those private illiquid assets. So like I tend to tell a cautious story on them, and they obviously have been very, very popular. I say that great history, but now we don't have any more the valuation advantage of privates over publics. They have become so popular, the inflows have taken so the valuation gap away. And then the other thing that was helping many privates was the cheap leverage. This is especially for private equity, which is sort of levered equity. So that cheap leverage is gone. So when those benefits are gone and the fees are still very high, it's going to be much harder for private asset managers to basically provide positive net returns. And when I'm telling these stories, or the story that the illiquidity premium should be off, or seems to be offset by the investor appreciation of that smoothness itself, that the smoothness advantage doesn't come for free, it comes by us bidding away illiquidity premium. These are stories that investors reliably nod on, and they seem to agree. But I think after the meeting with me, they go and buy some more illiquid investments. So I don't fool myself on how much impact I have. But at least I'm sort of, I'd say, raising their aspirations on working on the patience front and raising some doubts on the privates. And then the flip side of that, obviously, the much better diversifiers are the things that we have been touching a few times, the various long short strategies, whether it's a trend following or value or some multi-strategy approaches. All of these, I think, are so whatever the performance is, and there have been some hiccups there, they are clearly much better diversifiers than private assets, which have got lots of market beta. They just sort of take care of that fast beta. They don't suffer in that COVID type of event. But if you get a little protracted bear market or even longer one, they are going to give you full beta, full ugly drawdown. That can't be hidden. Whereas these long short strategies truly can be good diversifiers, and in some cases, like what you see in this last slide, they can even be risk mitigators that help when most needed in those bad times for equities.
All right, then. Well, thank you. I mean, on behalf of the CFA Society of San Francisco, I'd like to thank you sincerely, Antti, for sharing your insights with us today.
Very good. I enjoyed it, and yeah, thanks everyone for your time.
Well, thank you.